Good morning, everyone. Today is Wednesday, December 9th, and we here at Harvested Financial are looking at the markets. Before we totally get into that, though, I want to go over a couple things that all of the information, commentary, and discussion here are solely for the purposes of education, and anything represents the personal viewpoints and interpretations of the employees providing such comments and are not to be considered a description or offer of advisory services by Harvested Financial. The opinions expressed are for general informational purposes only and are intended to not to provide specific advice or recommendations for any individual or any specific security or investment product. It is only intended to provide education about the financial industry. In no way is any content on this website meant to convey investment advice, performance data, or any specific recommendation to buy or sell securities. Harvested Financial employs multiple methods of analysis and security selection to create client portfolios, which are not discussed in their entirety here. All investments carry the risk of loss, and users should not discuss any decisions with their financial advisor. Past performance is not an indication of future results. So now that we have that out of the way, let's start talking about what's going on today in the markets. Had a little bit of a turnaround yesterday. Markets started topping out, hitting some all-time highs. SPY closing all the way up at a little over 370. So SPY right now is actually even up again, only 10 basis points, 35 cents right there, trading at 370.54. IWM up $1.16 or 60 basis points. And the Qs, the laggard, they're down $1.05 or about 34 cents. So relatively calm, but the market does keep creeping up. We are pushing. We long talked about the seasonality effects here, the effects of all kinds of out of the money call buying that is driving the market, tech names which dominate something like 25% of the S&P 500. So we are continuing to see the seasonality, continuing to see the dealer impact on the market, and continuing the Santa Claus rally into the end of the year. So let's talk about one of the other big names out here in the market, and that is going to be Tesla. So Tesla, of course, is going to be joining the S&P 500 come December 21st. And they've been doing pretty well as an organization. They are, I apologize. So they've posted 5 straight quarters of consecutive growth. That was what finally pushed them over the edge into getting included by the committee. Their market cap has been huge for a long time, up there with the mega behemoths, but it's been that continued profitability. The stock is up 20% almost since announced and since their inclusion's been announced. So what are we going to look at here with Tesla? Well, why don't I share my screen and let's talk about some of the gamma action that's going on here and how we might use open interest to play the future direction of the stock. So I'm going to share my screen. I'm going to pull up my TradeHawk. As always, this is our partner Tradier's amazing options interface that really lets us get a lens into the markets and what's going on out there. So I've got Tesla up here. So I'm going to start by looking at actually, let's start by looking at the December option. So, the main December expiration is this December 18th. Where are people positioned? So the way we can figure that out is through open interest. And open interest is a variable that only gets updated T+1. So we don't find that out until the next morning after the OCC has done all kinds of processing and lets us know what the current open interest is. The open interest is the number of contracts held by buyers and sellers on that specific line, that specific call or put at that strike level. So as we know, every option contract has both a buyer and a seller. If you buy a call, someone is selling that call to you. One lot creates one element of open interest. There's a buyer and a seller. Add another 100 lot, that becomes 101 contracts of open interest. Now it's possible for people to close their open interest. The original seller could buy that back. They could buy it back from someone else, which would maintain the open interest level, or they could buy it back from that same customer and it would actually decrease the open interest level. So open interest is a really good barometer for knowing where people are positioned. It lets us know where the dealers are positioned on the liquidity provision side, and it lets us know where customers have generally been paying attention to option strikes. So looking at December 18th, I'm going to highlight 2 very specific strikes. And this is one of those curious things about the markets is sort of the round number fallacy. And that people like to buy at round numbers. People like to sell at round numbers. And we see that right here on this 600 line. So actually, to even be more specific, the open interest number that I'm looking at is right there for the calls and right there for the puts. So a little over, almost 35,000 contracts of open interest here, just under. on the 600 line. That compares to, just under 12,000 on the 610, just under 9,000 or just over 9,000 on the 620. So round numbers are particularly interesting. Let's look at another round number here. The 700 line also has pretty significant interest. So the 700 line, interestingly, dominated by calls. So 27,000 open interest in the calls on the 700 line compared to only 800 on the puts. We're much more balanced on the 600, still predominantly call dominated, but 35, just under 35,000 on the 600 line, and just about 28,000 on the 700 line. So right now where stock is sitting, we're almost right in between that. We're at like 641 right now this morning. So looking at the 600 line and looking at the 700 line, we have two major pools of open interest. And what that's going to create is some potential gamma swarm, where there's going to be a gravitational pull that is going to pull the contracts to that level. To the extent that dealers are hedging those options, they're going to draw that vortex in, and we're really going to see a sort of concentration or a gravitational pull, I should say, towards these different strikes. So how should we think about that? Well, one of the truisms in options trading is that you want to be short the strike where stock goes. You don't want to be short the strike that stock goes through, because that's where you're going to start losing money. If you sell a call and stock goes way above that, you're going to start losing money. But if you sell a call and stock goes right to that level, that's actually going to be your max profit zone. So if we want to pick either one of these short strikes, we have two different trade setups that I'm going to walk you through. So I'm going to set up one of our favorite setups is the modify here. And so I'm going to set up a little bit of a modify at the 600 level. This would be if you feel like there's a little bit more of a pull southward, maybe this rally has needs a little pullback, and sort of the inclusion in the S&P buying has already been baked in. So I'm going to sell two of the 600. Oops, let me clear my old positions. So I'm in D's. If I sell two of those, maybe buy the 650 and go all the way down to 500 to buy that guy. So what does that look like? Well, I need to expand this just a little bit because we got a huge stock price here. So what I'm really targeting here is a concentration right at that 450. I'm going to pay a little bit of money because this is relatively near term. So it doesn't exactly have the structure that we love, but that's really going to pin right at that 4,500 level. Or sorry, we're going to make $4,500 if it pins right at that $600 level. And we're going to enter this trade for a debit of around $400. So that would be our max loss on the upside. Well, what if you want to play it out a little longer? And I think actually that might be a little bit more interesting is if we go out to January and look at some of these levels. So we can see where it was in December, concentration around 600, concentration around 700. That is going to play into price action over the next days as the inclusion, becomes reality. But if we look out to January, maybe you want to play a little bit farther, capture a little bit more of that decay. 600 level, again, we see 2,200 contracts of open interest at the 600 level. And at the 700, wow, a little over 28,000 contracts of open interest. So the concentration isn't as severe in January here. You'll notice that we have 15, 17,000 right around the money. So it's not quite as lopsided out here. But thinking about those 2 points as potential sort of vortexes for the stock to go towards, let's set something up around the 600 level, and buy these, and then buy the 500s. And this we should be establishing for a credit, and that's the way we like to trade. So setting up that, we're going to take in a credit on this. We're going to take in almost $7. So this is an interesting play because it makes its max profit a little bit down. We're at 640 right now. It's going to make its max profit down at 600. So like I was saying before, if you feel like we might drift down that way, but you're still bullish, entering into a credit here gives you a max profit of $5,500 at that 600 level where, we might expect to see some vortex action. But on the upside, we do get all the benefit of this rally. So stock keeps going. Maybe it hits that 700 vortex level. We're still going to make that credit that we made, that we collected on the trade price, which is about $700 a contract. Now, our max risk, once we start going below 550, we are going to hit that max risk of a $4,500 loss at around 500. So from 550 to 500, we go all the way down from break even to a $4,500 loss. Let's talk about if we want to play the 700 level. So I'm going to clear this out. Another major level, and if you're even more bullish on Tesla, this might be the bent you're going. So remember, we're pinned in between 6 and 700. So I'm going to sell 2 of the 700s, I'm going to buy one of the 750s, and I'm going to buy the 600 now. So I'm setting almost a 50 and 100 leg on that modify. You'll notice we're collecting a lot more on this trade. So we are expressing a lot more of a bullish direction. It's technically a little bit further away. So we're actually going to collect almost $2,000 per contract. So $22 in single option terms, which would mean $2,300 of actual credit collected, cash credit collected. So a little bit of a tongue twister there. So as you would expect, we're going to see the max profit level right at that 700. So always the short strike. We want stock to go to our short strike, not through, to. So stock is going to sit right at the 700 level, and we are going to make $7 grand per contract on that. We have a little bit less of a downside buffer. So by moving our short strike up to that 700 level, we don't have as much downside. So, I'm looking at that break even really just below where we are now. So in many ways, this is saying stock is only going to go up between now and January, and I'm willing to accept losses on the downside. One thing you will notice, because we're collecting so much more credit, you're expressing that much of that bullish opinion, our loss is going to be quite a bit less. So, we're looking at closer to, just under 3,000, about a $2,800 loss, a little less, 2,740 loss in the, on the downside. And, stock ticks below 600, you are going to hit that max loss. But you're pretty well compensated because you have all the way on the upside. So we really run, stock goes above 740, you make about 2,300. So a little less than you would have lost in your max profit zone should we really go that other direction. A little bit than you would have lost in your max loss. But the thing I really like about this is that it gives a really fat max profit zone. So we sort of define the max profit zone as being this triangle window here. So anywhere below that sort of yield on the upside and above where it starts to go below that yield number. So looking at how wide that is here, we're going to start right there. Whoops. We're going to start right there. And so that number that we're going above is about a $2,300 figure, and that's the credit that we collect on the trade. So, we make 2,300 if stock is at 640. So right where we are now, anywhere up, basically between here and 740. So the next $100, we're going to be in that max profit zone centered around 700. So between here and 700, we're going to go from making $2,400 up to $7 grand at the max. And then at 740, above that, we're keeping our $2,400. So per contract. So this is a really nice setup to play in Tesla if you're a bull. If you think it's going to gravitate towards that 700 level, if you think there's still room to go as a lot of the passive buyers start to, include this in their S&P 500 tracking, or alternatively, if you think maybe that 600 level has a little bit more of that gravitational force, we can look at that 600 level trade. So a lot of different ways to take that open interest into account and use that to intuit where dealer positioning might create a vortex. Stocks tend to gravitate towards those big open interest levels. So it's something we're going to be watching going forward and a really interesting way to structure your trades. Here at Harvested Financial, we do all this for you. We structure modifies, we structure model portfolios, we design custom strategies for individuals. So take a look at our website at harvestedfinancial.com. Check us out on Twitter, harvested_DAFE, because derivatives are for everyone, and we want to bring the power of these option strategies to your portfolio. If you sign up using promo code POMP, P-O-M-P, you'll get your first 3 months for only $5. So check us out. Lots of fun stuff with option strategies, and we're here every morning doing daily bread 5 minutes after the markets open. Happy trading out there, everyone, and we appreciate you tuning in.